So you've got a property sitting in front of you, and the only question standing between you and your next move is whether to hand it over to a long-term tenant or throw it on Airbnb and pray the algorithm loves you. It sounds simple, but this single decision could mean the difference between a steady, predictable cash flow and a revenue roller coaster that has you refreshing your calendar like it's a slot machine. Let's be real. The short-term rental boom made a lot of investors feel like geniuses around 2019 and 2021, with some hosts reporting 2 to 3 times the monthly income of their long-term rental neighbors. But then came the regulatory crackdowns, the platform fee hikes, and the slow creep of market saturation that turned passive income into a part-time hospitality job nobody signed up for. The side-by-side model we're talking about today is basically your financial MRI. It scans both strategies at the same time, so you're not just guessing which one wins. Think of it like comparing 2 cars, not just by sticker price, but by insurance, gas mileage, maintenance costs, and how often they'll leave you stranded on the side of the road. To build this model, you start with gross revenue on both sides. For long-term rental, that's your monthly rent times 12, and for short-term rental, that's your average daily rate multiplied by your projected occupancy days. The tricky part is that long-term rent is a fixed number you can almost count on, while STR revenue is more like a weather forecast, directionally useful but never guaranteed. Now, here's where people get seduced by the wrong headline. They see the STR gross revenue number and do a little victory dance before accounting for expenses. A long-term rental might have an expense ratio of 30 to 40%, while a well-run short-term rental can bleed 50 to 60% of gross income before you even see a dollar of profit. Those STR expenses are no joke. You've got platform fees eating 8 to 15% right off the top, cleaning costs that can run $60 to $150 per turnover, restocking supplies, the higher utility bills, and the furnishing investment that can easily hit $15,000 to $30,000 upfront. Meanwhile, your long-term tenant is basically maintaining a self-cleaning ecosystem where you show up once a year to fix a leaky faucet and collect your check. On the long-term side, your model needs to account for vacancy, typically 5 to 8% annually, property management if you're not self-managing, another 8 to 12% maintenance reserves, insurance, taxes, and debt service. These numbers are boring, predictable, and beautiful. And in a world of uncertainty, boring and predictable is massively underrated. The real magic of the side-by-side model is in the net operating income line, or NOI, because that's where the two strategies stop looking like twins and start looking like completely different species. A property grossing $4,000 a month on STR might net the same or less than a long-term rental, bringing in $2,500, and that long-term rental let you sleep at night without worrying about a bad review from someone who complained the throw pillows weren't fluffy enough. Here's a historical truth that cycles back every decade or so when the economy tightens and travel slows. STR markets get crushed first and hardest. During 2020's early lockdowns, entire STR portfolios went dark overnight, while long-term landlords kept collecting rent, with some friction, yes, but they kept collecting. The investors who had modeled both scenarios in advance didn't panic, they'd already stress tested the downside. One major misconception is that STR always wins in tourist markets, and LTR always wins in suburban ones. That's lazy thinking that ignores your specific cost structure, local regulations, and personal bandwidth. A property in a hot tourist corridor with strict city ordinances limiting rentals to 90 days per year is not an STR goldmine. It's a compliance nightmare wrapped in a beachfront bow. Your model should also include a regulatory risk column, a simple red, yellow, green indicator for how stable the STR rules are in your target market right now. Cities like New York, San Francisco, and Santa Monica have made STR so restricted that investors who didn't model regulatory risk lost not just income, but entire business plans, sometimes overnight. From a practical standpoint, run your model with 3 scenarios on the STR side: a conservative occupancy of 50%, a base case of 65%, and an optimistic case of 80%. Then compare all 3 against your locked-in LTR number. If your LTR beats or ties the conservative STR case, the math is quietly telling you something important about where your real risk-adjusted return lives. The discipline here isn't about picking a winner before you run the numbers. It's about letting the numbers tell you the truth, even when the truth is less exciting than the story you told yourself when you bought the property. Process beats conviction every single time in this game, and the investors who model first and dream second consistently outperform the ones doing it in reverse. At the end of the day, both strategies can work beautifully when matched to the right property, the right market, and the right operator. And the side-by-side model isn't about declaring a champion. It's about making sure you're never surprised by the score. Run the model before you buy, run it again before you list, and update it every quarter. Because markets move, and the numbers that made sense in January might be lying to you by July. Whether the model points you toward a steady, long-term tenant or a fully booked short-term calendar, you'll move forward with clarity instead of hope. And in real estate, clarity is the only edge that compounds. Check out our links in the description below to get started with real estate investing, connect with a contractor, or find a lender who can help you take your next step.